Good afternoon, everybody. Today, you must be knowing that we are at Block 3, Unit 2 of Block 3 for Accounting for Managers. And the today's topic is Budget and Budgetary Control. But before starting the topic of today, I feel it expedient to complete the balance portion of the yesterday, which is an important part of the cost, volume, and profit analysis, which was being left due to paucity of time from the yesterday session. That should be completed first, and then only we will go to the today's topic, that is budget and budgetary control. So let us start from the cost, volume, and profit analysis. The graphical presentation, algebraic part was discussed yesterday, and the graphical part of cost, volume, and profit analysis have been part of different managerial decision making process. Let it be completed today. Then we will go to today's topic, that is budget and budgetary control. This is the graphical presentation of the break-even chart, which shows with the line which is parallel to the x-axis, that is the fixed cost line. In the x-axis, we are measuring the quantity, and in the y-axis, we are measuring the amount. If we refer to the graph, it gives rise to an angle of incidence. The angle of incidence, the larger the angle of incidence, the favorable is the position for any organization or for any unit which is indulged in the manufacturing of any product. The variable cost line, which is in a rising trend, there is an intersection of the total cost line and the total revenue line at the point of break-even, which is called break-even point or BEP, where there is no profit or no loss. And from this, one thing is being ascertained, that is called the margin of safety. The margin of safety means, you can know, the margin of safety is the difference or the sales beyond the sales at the break-even point. The more the sale effected by the organization beyond the sale at break-even point, that would come under the margin of safety. And the more the margin of safety, the more favorable is the position for the organization which is indulged in doing any type of production. So, taking this chart into consideration, we will discuss some of the practical applications of the marginal costing today, which is otherwise called the practical aspects of the CVP analysis, cost of volume profit analysis. And those 5 important practical applications which need to be discussed today. The first one is make or buy decision. The second one is accept or reject proposals. The third one is the key factor analysis. And the fourth one is optimizing the product mix. And the last one is the discontinuance or diversification of products. After discussing those 5 important components which were being left from the yesterday's session, we will go to the today's session, that is budget and budgetary control. So make or buy decision. While discussing the make or buy decision, we need to take an example. If you refer to the example given in the slide, the example says that a manufacturing company finds that while the cost of making a component in its own workshop is rupees 8 each, the same is available in the market at rupees 6.50, 6 rupees 50 paise, with an assurance of continuous supply. That means there is an assurance from the side of the supplier that there won't be any interruption in the supply of the product. As and when needed, it will be supplied. At this juncture, a suggestion is required whether to make or buy this component. Give also your views in case the supplier reduces the price from 650 to 550. The cost data is as under. The direct material of the product is 3. Direct labor is 2. Other variable expenses is 1. That means the total variable expenses of the variable cost comes to 3 plus 2 plus 1, that is 6. And The depreciation and the fixed expenses is rupees 2 per unit. While answering the question, we will find out that the marginal cost in material 3, labor 2, and other variable expenses 1. So the total marginal cost of the variable cost comes to be 6. In the above example, if the purchase price is 650, it is not advisable to buy the component from outside. Why? We should rather make the component of our own, because every component manufactured will give a contribution of 50 paisa, which will contribute towards the fixed cost. Because the variable cost is 6 and the selling price or the purchase price is 650, that means it gives rise to a contribution of rupees 50 paisa per unit, which can be contributed towards recovery of the fixed cost, because when we buy the product, we cannot stop the fixed expenses which are to be incurred at our end, rupees 2. So at this juncture, it is advisable that we should make the production of our own without affording to making the purchase from the outside party. Now, there is another thing. When the supplier is prepared to reduce the price from 650 to 550, that means per unit this price is being reduced by one rupee, then what should be our decision at this juncture? The company should not manufacture the component if it is available at 550. Why? The company should not manufacture, because in that case, it is better to buy than to make, because the 50 paisa per unit would be the negative contribution in our hand. So as a result of that, if we are purchasing from the outside, then it would be beneficial to the organization. And this decision is possible only through the marginal costing or the profit volume analysis. Let us come to the second major decision to be taken, or second major practical application of the CVP analysis: accept or reject. In this case, the example may be referred to: the Everest Snow Company manufactures and sells direct to consumers 10,000 jars of Everest per month at a rupees of 1.25 rupees per jar. The company's normal production capacity is 20,000 jars of snow per month. An analysis of cost of 10,000 jars is given below. Direct material is 1,000. Direct labor is 2,475. Power is 140. Jars 600. Miscellaneous expenses is 430. Fixed expenses is 7,955. In this way, total comes to 12,600. The company has received an offer for the export under a different brand name of 1,20,000 jars of snow at 10,000 jars per month at 75 paisa per jar. Now, write short report on the advisability or otherwise of accepting the offer, whether the offer has to be accepted or to be rejected. In this case, we will make an analysis. There would be 3 categories. One is the present capacity at the rate of 50%, then proposed another 50% capacity, then total 100% capacity. Then the sales would be 10,000. At the units, the sales would be 10,000. Proposed another unit would be 10,000. Total would be 20,000. Sales value at 1 rupees 25 paisa per unit, it comes to 12,500, 7,500 for additional, and in total it comes to 20,000. Direct material is 1,000, 1,000, and total 2,000. Direct labor, accordingly, it is 2,475, and the total is coming 4,950. Power 140, and the total 280. Miscellaneous supplies 430, and the total is coming 860. Jars are 600, and the total is 1,200. The contribution, if it is calculated, sales minus variable cost, 12,500 minus 4,645, it comes to 7,855 for column 1. And for column 2, it is coming 2855. The fixed cost is 7,955. So in the first case, it gives rise to a loss of rupees 100. But in case of at the present level of production of 10,000 units, there is a loss of rupees 100. But if the additional 10,000 units are sold, it converts the loss of rupees 100 into a profit of rupees 2755 as computed in the third column. In spite of the facts that the additional offer of 10,000 units at the rate of 75 paise per unit is giving us a profit of rupees 2,755. As no additional fixed cost is required, the offer is definitely to be accepted by the organization without any second thought. So this is about the second major decision to be taken as regards accept or rejection of the proposal. Then let us look to the next slide, which gives us the information about the key factor analysis. Key factor analysis means when there is a particular key factor, at times the material may be the key factor, at times the labor may be the key factor, at times the power may be the key factor. So accordingly, taking the key factor into consideration, we need to take a decision as regards production of any product or any product mix. In this juncture, let us take the example. In a factory producing two different kinds of articles, the limiting factor is availability of labor. So labor is the key factor here. From the following information, so which product is more profitable? There are two products, product A and product B. Cost per unit of product A material is 5 rupees, and for product B also the cost per unit is 5. For labor, it is 3, and for product B, it is 1 rupees 50 paise. And the labor is 3 hours at the rate of rupees 50. This is the breakup of the labor. So overheads, the fixed 50% of the labor. Accordingly, it is coming 1 rupees 50 paise for product A and 75 paise for product B. And variable cost is 1 rupees 50 paise and 1 rupees 50 paise for product A as well as for product B. So the total cost of product A is coming 11 rupees, whereas the total cost for the product B is coming 8 rupees 75 paise. The selling price is 14 for product A and 11 for product B. Thus, it gives rise to a profit of rupees 3 for product A and 2 rupees 75 paise for product B. Total production for the month is 500 units for product A and 600 units for product B. Maximum capacity per month is 4,800 hours. Give proof in support of your answer. The key factor is labor here. The answer is given here. Selling price of product A is 14 and the selling price for product B as given is 11. The variable cost for A, direct material is 5, direct labor is 3, overheads are 1.50. It comes to 9.50. When it is deducted from the variable cost is deducted from the sale price for product A, it comes to 4 rupees 50 paise. So the contribution for product A is coming 4 rupees 50 paise. Labor hours required per unit is 6 hours as given in the illustration. So here the contribution per hour is coming 75 paise. 4.50 the contribution divided by the labor hour, it comes to 75 paise per hour. If we look to the product B, the selling price is 11, the variable cost is 8, thus it gives rise to the contribution of rupees 3, and the labor hour required per unit of product B is 3 hours. So per hour contribution, since the key factor is the labor, so per hour contribution is coming 1 rupee here. In case of product A, it is 75 paise. In case of product B, it is 1 rupees. So definitely the product B is more profitable because it gives more contribution by 25 paise per hour of the labor cost, which is the key and the limiting factor here. So thus, while taking a decision about the key factor analysis, we can take a decision accordingly. Then the next one is optimizing product mix. Optimizing product mix, it is coming that if there are different product mix, which product mix is beneficial and profitable to the organization, and accordingly the decision has to be taken by us. For that, the example may be referred to. Present the following information to show clearly to management the marginal product cost and the contribution per unit, the total contribution and profits resulting from each of the following mixtures. There are two products, product A and product B. Direct material is 10 rupees. I am talking of product A. For product A, the direct material is rupees 10. For direct labor, it is 3. Direct sell price is 20 for product A. And for product B, the direct material is 9. The direct labor is 2. And the sales price is 15. Fixed expenses is rupees 800. Variable expenses are allotted to the products as 100% of direct wages. That means direct wages is the basis of allocation of variable expenses. Sales mixture, there are 3 options are given here, A, B and C. One mix is 100 units of product A and 200 units of product B. The second option is, second product mix is 150 units of product A and 150 units of product B. The third option, this third product mix is 200 units of product A and 100 units of product B. So when we will calculate this, selling price, when it is represented in a tabular pro forma, the selling price is 20 for product A. First we will calculate of product A, the selling price is 20, less marginal cost, direct material 10, direct labor 3, and variable cost at the 100% of wages, that would also be 3. So the total variable cost comes to be 16. When the total variable cost is 16 and the total selling price per unit is 20, then obviously it will give rise to a contribution of rupees 4 per unit. Accordingly, if it is the contribution is computed for product B, the selling price per unit is 15 and the variable cost is 9 plus 2 plus 2, that means 13. Thus, it gives rise to a contribution of rupees 2 per unit. When you take the mixture of sales as per A given, 100 units of product A and 200 units of product B, then the contribution for product A would be 100 into 4 plus 200 into 2 for product B. It comes to 800 and the fixed expenses is 800. So at this point, when we add to the product mix of given under A, then we are at break even. That means there is no profit, no loss, because the total contribution is exactly able to cover up expenses. Nothing goes beyond that, so there won't be any single pie towards profit. If you refer to the product mix given under B, category B, 150 units of product A and 150 units of product B. In that case, the contribution for product A would be 150 into 4 plus 150 into 2. That means 900. 900 is the contribution and the fixed expenses is 800. Thus, it gives rise to a profit of rupees 100 in our hand. The contribution after recovering the fixed expenses, it gives rise to a surplus which is called profit of rupees 100 in our hand. In case of third product mix, when 200 units of product A and 100 units of product B are being produced, the contribution for product A would be 200 unit into 4 plus for B 100 units at the rate of rupees 2. It is coming to 1000 rupees. And the fixed expenses is the same as 800 in earlier cases. So this gives rise to a profit of rupees 200. The contribution is 1000 and the fixed expenses is 800. That means after contributing towards the entire fixed cost, there is still a surplus of rupees 200 in the hands of the organization, which is towards the profit of the organization. So in case of situation A, there is no profit. In situation B, there is a profit of rupees 100 in our hand. And in case of situation 3, there is a profit of rupees 200 in our hand. As such, the product mix as given under C category gives the maximum profit, so that has to be selected by us, and the other two product mix are to be omitted or are to be rejected. So this is the fourth major decision to be taken as regards the optimization of product mix, how to optimize the product mix in our hand. The last important practical application as regards the CPV analysis is discontinuance and diversification of products. How to take a decision in regards which products are to be discontinued, or in what way we should go for diversification of products in our organization. For that, we may take the example as given in the slide. The example says that the management of a company considers that the product B, one of its three main lines, it is not as profitable as the result, that no particular efforts are being made to push its sales. The selling prices and costs of these products are as follows: product A, product B, and product C. Selling price for product A is 50. Selling price for product A is 50, selling price for product B is 40, and the selling price for product C is 45. And the direct material for product A is 10, and for product B it is 6, and for product C it is 8. And direct labor for department X, department Y, and department Z, it is 4 rupees for product A under department X, and 2 rupees for product B for department X, and for product C it is 2 rupees. For department Y, for product A it is 2 rupees, for product B it is 4 rupees, and for product C it is 2 rupees. And for department Z, for product A it is 2, for product B it is 2, and for product C it is 4. It has been realized in the slide. Overhead rates. Overhead rates for variable overheads for product A it is 1.25, for product B it is 0.50, and for product C it is 1 rupees. And for product fixed overheads for product A it is 1.25, for product B it is 2, and for product C it is 1.50. Now, what advice would you give to the management about the profitability of product B? There are 3 products: product A, product B, and product C. It has been given as calculated in the next slide. Let us look to the next slide. The selling price of product A is rupees 50 as given in the question, in the example. And the variable cost or the marginal cost, direct material is 10, direct labor is 8, and the direct labor is 8, and the other expenses as per department X, Y, and Z, the overheads, it is 5, 1, and 2. So the total variable cost or the marginal cost is coming to 2610 plus 8 plus 5 plus 1 plus 2 for product A, that is 26. So the contribution, sales minus variable cost, it is 24 per unit of product A. And the PV ratio would be 48%, because 24 divided by 50 into 100. So for product A, the PV ratio is 48%. Accordingly, if it is when it is calculated for the product B, its selling price is 40, and the marginal cost, the direct material is coming 6, direct labor is coming 8, and overheads 2 rupees 50 paise for department X, for department Y it is 2 rupees, for department Z it is 2 rupees. So the total variable cost comes to 20 rupees 50 paise. The selling price is 40 per unit, so the contribution is sales minus variable cost, it is coming 19 rupees 50 paise. When the contribution is 19 rupees 50 paise, the PV ratio would be, profit volume ratio or the contribution to sales ratio, 19.5 divided by 40 into 100, it is coming 48.75%. And when the same calculation is made for product C, its selling price is given to be 45 and its variable cost, direct material is 8, direct labor is 8, the overheads 2 rupees 50 paisa, 1 rupees and 4 rupees. So the total variable cost comes to be 23 rupees 50 paisa. So the contribution is sales minus variable cost 45 minus 23 rupees 50 paisa. 21 rupees 50 paisa is the contribution per unit. When the contribution is 21 rupees 50 paisa and the sales is 45 rupees, the PV ratio would be 25.50 divided by 45 into 100, it is coming 47.77%. As the PV ratio of product B is the highest, for product A it is 48%, for product B it is 48.75%, and for product C it is 47.77%. So obviously the PV ratio for product B is the maximum, hence that is the most acceptable product amongst all the three A, B and C. So these are the major practical applications of the marginal costing which was left to be discussed yesterday. Thus I feel it expedient and to discuss it today. Otherwise it would have been a what is that? I would have got a sorry figure before you people, because these are the important parts of the cost volume profit analysis. It could not be discussed yesterday only due to the paucity of time. So now let us jump to our own topic of today, that is budget and budgetary analysis. Let us move to the slide, budget and budgetary analysis. Budget means budget in general. There towards the fag end of the file. Budget in general means a plan in monetary terms for a defined period of time showing income and expenditure incurred and capital employed to attain objective. This is a common definition of the budget, which is generally accepted by many people. But CIMA, that means the Chartered Institute of Management Accountants of London, they have given a very lucid definition of the term budget. They are of the opinion that budget is a plan quantified in monetary terms, prepared and approved prior to a defined period of time, usually showing planned income to be generated and or expenditure to be incurred during that period and the capital to be employed to attain a given objective. This is what the meaning of the term or the definition of the term budget as given by the Chartered Institute of Management Accountants of London. And this is treated as the most acceptable and lucid definition of today. So, if this is the definition of the budget, then there are 7 essentials of the budget. The term budget is having 7 essentials. The first essential is, it is a plan expressed in monetary terms, but it can also contain physical units. The quantity may be given, the financial figures may be given. These are the 2 requirements of the essential. The first, it may be in monetary terms, and at the same time, it can be quantified in physical units also. The second essentials of the budget is, it is prepared prior to a defined period of time. Always budget is prepared in advance. If the financial year is 22-23, then the budget must be prepared prior to 31st March 22, well in advance. The second essentials of the budget is it is related to a definite period. That means either for a year or for a half year or for a quarter or for a month. It always relates to a definite period. Normally, it is being prepared on yearly basis. Very recently, the Union Budget of Government of India for 23 is being announced in the Lok Sabha. Our finance minister has declared has given the budget speech, and the Union Budget has been made publicized. So this is for the year 23-24. So the periodicity of budget is normally 1 year for all organizations. So this is the third essentials of the budget. The fourth essential of budget is it is approved by the management for its implementation. The budget need to be approved before its implementation. Implementation means when expenses have to be incurred, incomes are to be earned in the subsequent period for which the budget relates. There must be a comparison between the budgeted figure and the actual figure. So the management must approve it before it is being implemented. That is the fourth essentiality of the budget. The fifth essentiality of the budget is it shows the planned income and expenditure. That means from which sources the income would be generated by the organization and to what extent. And after generation of the income for that particular year or that particular period, in what way it has to be spent and what are the details of such expenditure to be incurred in an advance, it has to be incorporated in the budget. So that is the fifth essentiality. The sixth essentiality of the budget is it shows about the capital employed also. There may be income. Income in this connection, I would like to say that what is the meaning of the term income? Income means the gross inflow of cash or cash equivalent resulting out of sale of goods, rendering of services, or utilization of any resources of the organization, but excluding the receipts on behalf of third parties. So there are three components from which the incomes are generated by any organization. It may be from sale of goods. If the organization is indulged in manufacturing of any product and its subsequent sale, then in that case, the income would be coming from the sale of goods. In case of service sector organizations, when there is no sale of goods, take the example of an institution, educational institution like school, college, or university. Is there any sale of product there? But they are having income. The income is coming from rendering of services, that is imparting of education. When imparting of education, when the income is coming as tuition fee from the students, that means the second component of the income, that is rendering of services. So the second source of income is coming from rendering of services. The third source of income is coming from utilization of any resources of the organization. Take the example of any surplus fund in the hands of any organization. When there is any surplus fund in the hands of any organization and that surplus fund is being kept in any bank or in financial institutions in form of a deposit, let it be a term deposit for a longer period, then it will definitely generate some income on that. That is called interest, periodic interest. That interest is also an income in the hands of the organization of the depositor organization. So it comes from three sources like sale of goods, rendering of services, or utilization of any resources. The last component of the definition of the income says excluding the receipts on behalf of third party. That means if there is any receipt in the hands of the recipient on account of a collection which belongs to a third party, then that cannot form part of the income of the organization. What is that? Suppose you had been to Pantaloon for buying of a trouser, and the price of the trouser, the basic price of the trouser you have chosen is 1,000 rupees, and it is subject to GST at the rate of 10%, say. Basic price is 1,000 rupees, and GST is 10%. So you need to hand over a sum of rupees 1,100 at the counter for taking delivery of the trouser you have chosen. So in that case, 1,100 is the gross inflow of cash on account of sale of trouser by the pantaloon. But the income would be restricted to that 1,100 includes 100 rupees towards what? Towards the GST on that particular product, which has to be paid to the government in due course. So that collection of 100 rupees towards GST is not belonging to the pantaloon people. It is a collection on behalf of third party and the government is the third party here. So that GST has to be paid to the government in due course within the stipulated time period. So that 100 rupees cannot form part of the income of pantaloon on account of sale of trouser, the particular trouser you have chosen. So this income would be restricted to 1,000 rupees, excluding the collection on behalf of third party. So whatever income are generated in the hands of the organization, there should be a proper planning for that. Which are the sources available and what is the amount involved in each sources, and accordingly the budget has to be prepared in advance for the period. Beyond that, after consideration of the incomes and expenses, there should be introduction or infusion of capital, because at times expansion is needed. At times the revenue may fall short of the expenses to be incurred. If there is huge expansion program to be undertaken by the organization, the surplus of income may not be sufficient to cater the need for making the expansion of the organization. In that case, infusion of capital is a must. So if there is a proposal like this, heavy capital expenditure are proposed to be incurred during the budgeted period, then obviously the infusion of capital has to be made, and the infusion of capital has to be segregated, that from which source the infusion has to be made. It has to be provided for appropriately in the budget so that it will not lead to any anomaly in the future period when the budget is to be implemented. So capital employed, the infusion of capital during the budgeted period has to be explicitly mentioned in the budget, which is the essentials of a budget period. Then the last essential of the budget is it is prepared for implementing the policy of management in order to achieve the objective. The financial objective need to be achieved, and the management is interested on that. Without that, the budget is of no meaning. The management of the organization, why they are preparing the budget is being prepared, then it is approved, then it is implemented. And the implementation of the budget must give the desired result to when it is put into practice, the desired result of the management must be achieved. Otherwise, they may feel otherwise. So this is what the budget is. Then if we look to the classification of budget can be classified into different categories. There are three bases of classifying the budget. One is on the basis of time. The second category of classification is functions. And the third category of classification is flexibility. So when the budget is classified or categorized according to time, there are four categories of budget, four types of budget. One is the long-term budget, another is the short-term budget, third one is the current budget, and the fourth one is the rolling budget. Long-term means it is long-term in nature, very long-term in nature. Short-term means for a short span of time or for a particular project or for a limited period of time for a specific objective. Then current budget, very recent, it has to be prepared in a concurrent manner and it has to be implemented in a concurrent manner too. That is the current budget. So the first three categories of budget, that means long-term, short-term, and current, there needs no major explanation. There is another budget which is called the rolling budget. In case of rolling budget, what happens? It has to be prepared on concurrent basis. Means suppose there are 4 quarters in a year. If the first quarter it is from 1st April and ending with 30th of June. Then the second quarter, it starts from 1st of July and end with 30th of September. The third quarter starts from 1st of October and end with 31st of December. The last quarter starts from 1st of January and end with 31st of December. When the first quarter is over, that means when the budget per annum is being prepared in a rolling budget, what happens? If the first quarter is over, that means the implementation, it was prepared in advance and the first quarter in reality is covered, then the next quarter's budget has to be prepared and it will be stressed for the first quarter of the next financial year. If the second quarter of the budget is over and its implementation is covered, then this again the second quarter of the next financial year budget for the second quarter of the next financial year ought to be prepared. That is called rolling budget. That means it will be a continuous process. That means it will be going on one after the other. So these are the 4 types of budgets under the when it is classified so far the time is concerned. The budget may be classified, the categories of budget may be classified as per the functions of the budget. When the budget is classified as per the functions, it is sales budget, it may be production budget, it may be cost of production budget, it may be purchase budget, it may be personnel budget, it may be research and development budget, it may be capital expenditure budget, it may be cash budget, and finally it may be a master budget which covers all the categories of budgets as discussed earlier. So these are the categories of budget. Mainly there are the different departments in the organization are there. They used to prepare the budget of their own department. The sales department will prepare the sales budget. The production or the manufacturing department will produce the production budget. And the cost of production, the costing department must be there in the organization which will produce the cost of production budget. The purchase department will prepare the purchase budget. The personnel department or the human resource department will prepare the budget for the personnel. Then there must be research and development wing which will prepare the budget for research and development. Then capital expenditure. Capital expenditure means the future expansion of the organization. The engineers must be there, the financial experts must be there. We will make the financial analysts taking the investing decision-making approaches. There are different criteria for investing decision-making, and accordingly they will prepare the capital expenditure budget and cash budget. Cash inflows and outflows, it has to be taken into consideration, and the cash budget has to be prepared by the finance department. Then after that, the master budget has to be prepared, which includes all the components, all the departments and departmental aspects, and a master budget is prepared for the organization as a whole. This is called the This is called the master budget of the organization. Then, as per the flexibility, if the budget is classified, then there will be 2 types of budget. One is the fixed budget, another is the flexible budget. Beyond this, there is another type of budget which is called the zero-based budget. Under zero-based budgeting, techniques suggest that an organization should not only make decisions about the proposed new programs, but it should also from time to time review the appropriateness of the existing programs. So in that way, the zero-based budgeting has got significance and importance of its own. So organizations, they may go for preparation of the zero-based budget. Then budgeting. After budget, we will discuss the budgeting. Budgeting means the process of preparation of budget, implementation of budget, and operation of budget. Preparation of budget means it has to be prepared in advance by the finance department or purchase department or sales department or whatever it may be. And after preparation of the budgeting, it is a continuous process. The preparation is to be done in a continuous process. Requisition has to be made from other departments. All the data are to be congregated together and the budget has to be prepared. Then after preparation, we need to think of implementation of the budget. When the budget is prepared and approved by the management, then it has to be communicated to the department who are to implement the same, and they are to be provided with the adequate infrastructure, the adequate information about implementation of the budget in the actual financial period, so that there won't be any gap between the budgeted figure and the actual figure. Then operation of the budget, that is also to be, after implementation, how it is to be implemented, whether it is going in a correct way or not, that aspects are to be taken care of under the operation of the budget. Then the next component is, after budget and budgeting, the next component is budgetary control. Under budgetary control, the budgeting is otherwise called the art of building budget, that is called budgeting. Under budgetary control, there are we need to establishment of budgets, continuous comparison, various ascertainment, investigation, and corrective action. We need to establish the budget. That means we must be firmly convinced about what has to be the components, different components of the budget, what we are going to design for the next period, next financial period. Then after establishment of the budget, after establishment of the figures in respect of different items and nomenclatures, there should be a continuous comparison. In case of a budget, continuous comparison means comparison between the budgeted figure and the actual figure. If for a particular item, the budget figure is differing from that of the actual figure, obviously there will be some minor differences may be there which we can ignore. But if the differences are coming to a sky-high figure, then it has to be analyzed properly. That comes under the next category, variances ascertainment. That means we need to find out where there is variances, which figures are differing substantially from the budgeted figure and the actual figure. When that variances are ascertained, the next step is, under the budgeting control system, the next step is investment or investigation. Under investigation, we need to investigate that what are the causes of such variation, why the actual figure differs from that of the actual, what are the reasons behind that. That has to be ascertained properly, and that can only be ascertained with thorough investigation by the authorities. And after investigation is made, the corrective measures or the corrective action has to be taken to know or to find out the reason and rectify the reason, to rectify the defects as ascertained under the investigation. So these are the aspects which are to be covered under budgetary control. The next feature is, the next step in the budgetary control is features of a budget. Under features of the budget, the first step is duration. The duration of a budget may be monthly, maybe quarterly, maybe half yearly, maybe yearly. But normally it is being prepared on a yearly basis. So that is the very first feature of the budget, that is called duration. Then estimation of profit potential. The second feature of the budget is profit potential. Profit is the main aim or the fact behind provoking any organization or any management to go for all these things, budgeting, financing, all the aspects, profit making, all these things are backed by what? The estimation of profit. So the estimation of profit plays a potential role in preparation of the budget. That's why it is one of the important features of the budget. Then appraisal of performance. When after preparation of the budget, it goes for implementation, that means it is practically implemented in the period for which it is being prepared, then the question of appraisal of performance arises. We need to analyze that whether the budget is being implemented properly or not, and if it is not properly implemented, then what is the reason behind its defalcation in the proper implementation. For that, we need to appraise there must be an appraisal of the performance of the persons who are implementing the budget in the organization on actual basis. So that is called appraisal of performance. After appraisal of performance, the next feature of the budget, monetary terms. The budget is mainly in monetary terms, but at times it is provided or it is supported with quantitative data also. But mainly it is being dealt with in monetary terms. Monetary terms means it has to be measured in terms of money. The emotional parts of the organization should not form part of the budget. Only it has to be expressed in terms of money, and at times the quantitative information ought to be given to supplement the monetary informations as given in the budget. The fourth feature of the budget is, so fifth feature of the budget is alteration of approved budget. At times, after approval of the original budget, it may require some addendum or addition or alteration, because everything is predictable, unpredictable. If in case of certain exigencies, it is required to make some addendum or make some alteration in the budget, then it must have the provision. The budget must have the provision for alteration of approval system. If it is non-negotiable in nature, if it is not subject to addendum or not subject to changes in the future, then it would be a drawback of the budgetary system. So alteration of approved budget must be, that provision must be there, that feature must be there in case of a good budget. The last features of a budget is review and approval. That means at the end of the period, there should be a proper review about the preparation of the budget and the implementation of the budget. If there is no gap, no major gap between the implementation and actual figure and the budgeted figure, which is not detected at the end of the year when we make a comparison between both the figures, then it's very fine. But if some gap, some major gap is being determined or detected between actual figure and the budgeted figure, then it has to be reviewed properly. And approval has also to be obtained accordingly. If we are seeing that a certain particular, suppose we are not able to achieve the purchase figure properly or the sales target properly, in that case we need to analyze that what is the reason behind not attaining the desired figure as regards sales or purchases or any other aspect. And if the reason is found to be genuine, it is supported or backed by the reasons, and the reasons are well acceptable, then there is no way out than to approve the variances. If there is any difference, even to a major extent, that has to be ultimately approved by the organization without any second thought. So these are the features of the budget. After feature of the budget, we will look to the utility of a budget. Why we need to exercise or give so much of time on preparation of the budget. These are called the utility or the usability of the budget. The first utility of a budget is optimal utilization of resources. Resources may be labor, resources may be material, resources may be power or anything else. So when we are having certain resources in our hand, and that resources need to be put to the production activity or the organizational activities, then while preparing the budget, we must see all the resources what are available in our hand are utilized to its maximum extent. Let it be power, let it be land, let it be material, let it be human resources, let it be infrastructure, whatever it may be. All the material informations, all the materials which are available, all the labor facilities which are available in our hand, they are to be utilized to its maximum extent, and the budget should be prepared accordingly. No part should be kept idle or should be ignored while preparing the budget. Then management by exception. In this case, there may be some items may be excluded, which may be due to the managerial activities or due to some of the key factors of the management as regards in decision making, but it should not play a very significant role. for purpose of utility of a budget. Then performance evaluation. The performance evaluation was also there in case of the previous segment. So the performance evaluation is always required, whether as regards the implementation of the budget, preparation of the budget. If the budget is not prepared in a proper way, then it will give rise to the difference between the actual figure and the budget figure. If the budget is prepared in a proper way, but there is a defect in implementation, this will also give rise to a difference between the actual figure and budgeted figure. So the performance evaluation as regards the preparation of the budget and the implementation of the budget, both have to be taken into consideration. And this is the utility of the budget: performance evaluation of the employees, of the workers, and the other aspects of the organization. Then coordination. There should be proper coordination between each and every department so that the budget can be utilized in a proper manner. If the sales department is going in a different direction and the purchase department is going in a different direction, there is no coordination between the two, then there is a lack in the system of budgetary implementation. So that has to be taken care of. It has to be seen that there is proper coordination between department and department. Then assignment of responsibility. When the budget is being prepared, the preparer of the budget must be responsible for preparing it on the basis of accuracy. And while implementing the budget, the implementers, that means when it is worked out properly by different departments at its floor level, both are responsible for its actual implementation and actual preparation. So the responsibility should be assigned. The accountability must be fixed with each and every person who are responsible for the preparation and implementation of the budget, as a result of which they would be more cautious and careful for their duties and responsibilities for utility or utilization of the budget in its real field. Then compelled planning. When there is a preparation of the budget, indirectly it forces it put it under compulsion to make a planning for its future. Budget means planning for a future, so it compelled planning. When we are preparing the budget, we must make a proper plan for its future growth, development, and other things. So whenever there is any budget, the planning would automatically be there for future, because it is a very inherent ingredient of the budgetary system. Then communication. Communication means when we are preparing a budget, there should be a proper communication between department to department. If the budget is prepared and it is implemented by different sections, there is no communication, there is no coordination between department to department, then it is sure and certain that the utility of the budget cannot be attained properly. The next is prerequisites of budgetary control system. When we are putting a budgetary control system into practice, when it is implemented in any organization, then what are the prerequisites of the budgetary control system? The first one, the foremost prerequisite is top management support. If the management doesn't support the preparation of the budget and the implementation of the budget, then everything would become futile. It will be of no use. It may be prepared in a proper manner, but if the approval of management is not done and the approval is not directed to be implemented by the various departments, then it is of no use. So the first and foremost prerequisites of the budgetary control system is the support of the top management. When the top management is in support of the preparation of the budget and its subsequent implementation, then everything will be going smoothly and the desired result can be well achieved. Then the second prerequisite is proper organizational structure. If the support of management is there, but the organization structure doesn't support the system of preparation and the implementation of the budget, then simply the approval of the management support will also become futile. So the organization structure should be designed in such a manner that the implementation of the budget and the preparation of the budget First, it has to be prepared, then it has to be implemented. Both the aspects should go in a parallel manner so that the proper organizational structure is of prime importance. Then, clear and realistic nature of goals. We must be very confident about our goals. It has to be set in advance properly. Otherwise, the desired result cannot be achieved. Then flexibility. It must be flexible in nature. Adjustment, provisions for adjustment, it should be there in case of a budgetary control system. The next prerequisites for budgetary control system is participative process. It should not be unilateral. It should be on a team basis. So that participative process should always be there to make the budgetary control system a favorable one, which would be best suited to the organization for deriving the better result. Then the last prerequisite of a budgetary control system is conducive environment. The environment should be very conducive and the people should be very palatable in their approach to make the budgetary system control unique, and it would definitely give a better and better result for the organization as a whole. Thanks to all.